Hello, dear friend, dear followers, dear lovers of this Patera TV. You are running and training platform about business courses. I'm your partner. I'm called Benone. So today we are going to give suggested answer about to the question related to the preparation of financial statement. Dear friend, dear lovers, dear followers of this Patera TV, please subscribe on this YouTube channel on this Patera TV in order to get new update about two new videos, the videos which give this suggested answer about the two various question which is asked in job exams. Like about to this video, share this video to your friend, to your group, and comment below of this video in order to encourage us, and what you are going to do about to this video is valuable asset to us. So dear friend, dear followers, this question is question related to the preparation of financial statement. So the examiner asking the to prepare X business profit and loss account for the year ended July 31st, 2015, and to prepare X business statement of financial position on July 31st, 2015. As you see, dear friend, dear followers of this Patera TV, this is the closing balance account which have been given to us to use it in the preparation of those financial statement. So clearly, in order to give the suggested answer very well, let me start by reading this question and try to understand this question. That is the route to give our suggested answer. So this question is stating that the data below apply for the X business for the accounting period ended July 31st, 2015. So the cash balance is equal to Rwandan franc 27,190,000. Account receivable is equal to Rwandan franc 60 million. Cost of goods sold balance is equal to Rwandan franc 20 million. Serious notes payable is equal to Rwandan franc 10 million. Allowance for doubtful accounts is equal to Rwandan franc 2 million. Finished goods inventory balance is equal to Rwandan franc 17 million. Prepaid insurance. So this prepaid insurance is highlighted because we are going to discuss in deep this prepaid insurance in giving suggested answer to this question. So this prepaid expense is equal to Rwandan franc 4 million. Long-term bank borrowings is equal to Rwandan franc 15 millions. Breedings is equal to Rwandan franc 80 million. Working in progress inventory balance is equal to Rwandan franc 9,310,000. Profit tax is equal to Rwandan franc 30% of the profit after before tax. Bad debt expenses is equal to Rwandan franc 2 million. 5 years bonds payable is equal to Rwandan franc 18 millions. The retained earning is the question, is what we are going to search when preparing the statement of a profit and loss account. So insurance expenses is equal to Rwandan franc 1 million. Gain on disposal of fixed asset is equal to Rwandan franc 500,000. 5 months not payable is equal to Rwandan franc 4 million. The sales revenue is equal to 50 million. Accumulated depreciation on buildings is equal to Rwandan franc 60,500,000. Suppliers balance is equal to Rwandan franc 2 million. Raw material inventory balance is equal to Rwandan franc 15 million. Tax payable balance is equal to Rwandan franc 60,690,000. Account payable is equal to Rwandan franc 8 million. Supplies expenses is equal to Rwandan franc 1,500,000. Common stock is equal to Rwandan franc 50 million. Utility expenses balance is equal to Rwandan franc 900,000. Advertising expenses is equal to Rwandan franc 2,800,000. Treasury stocks or required owner share is equal to Rwandan franc 30 million. Land balance is equal to Rwandan franc 15 million. Unearned service revenue. Dear student, dear followers, dear friend of this particular TV, this unearned service revenue is highlighted because also this is the item also we are going to talk about more to this unearned service revenue in order to understand the very well suggested answer to this question is. So the unearned service revenue is equal to Rwandan franc 5 million and 700,000. So dear friend, dear followers, dear brothers of this particular TV, before I go in deep in answering what you have asked for, so we are going to start by explaining some technical term, some item which is complicated to understand. So by the time you have understand this item and unearned revenue, the prepaid expenses, their definition and their treatment in the financial statement, to give the answer of this above question, it is became easier. Dear friend, dear followers of this particular TV, unearned revenue is money received by an individual or company for services or product that has yet not been provided or delivered. For example, dear friend, if you are a business and you receive a money from a customer in order to give that customer some service or some goods, but at the time you have received the money, you have not provided those services or you have not delivered those products to the customer, that money you have received is an unearned revenue. It can be taught for as prepayment for goods or services that a person or company is expected to supply to the purchaser at a later date. So, because of this prepayment, the seller has a liability equal to the revenue earned until the good or services is delivered. The unearned revenue is money you have get for expected for the goods you are planning to supply to the passenger at a later date. Means that you have not already supplied or delivered that product to the customer, but you have received the money for it. So because of this prepayment, the seller has a liability equal to the revenue earned until the good or services is delivered. So by the time you have received the money of a customer and you have not given him or provided to customers the service which has purchased to you, or you have not provided or delivered goods to the customer which have purchased to you, those earned revenue is liability to you. So an earned revenue is also referred to as deferred revenue and advanced payment. Dear followers, dear friend, dear viewers of this particular TV, in other question elsewhere you have seen deferred revenue or advanced payment is also the same as an earned revenue. This means the same things. An earned revenue is recorded on the company's balance sheet as a liability. So when you have received the money or anything from customer as consideration, but you have not provided a service for that something you have received, or you have not transferred a product for that asset or for that money you have received, that an unearned revenue, what you have received is a liability to you, which are going to be recognized or recorded on the company's balance sheet. So it is treated as a liability because the revenue has still not been earned. Means that it is treated as liability because the revenue has not been earned, has not been received to the relating financial period, and represent a product or services owed to customers. As the prepaid service or product is gradually delivered over time, it is recognized as revenue on the income statement. So in order to understand this sentence, let me see for this example. For example, if Patera TV receives training fees for over 12 months is equal to 124,000. The amount is recorded as increase in cash and increase in earned revenue. Dear friend, dear followers, dear viewers of this particular TV, if you are a business and at the start of the year you receive the some income which you are going to receive in our year. At the start of the year, you have received the amount of money which could be received a whole year. So at this the opening date of the year, how you are going to record that amount. So at this opening date, you are going to debit cash. For example, if the money you have received is 24,000, you are going to debit cash Rwandan fra 24,000, and you credit an unearned revenue 24,000. But if so, both are the balance sheet account. This debit, this cash, and this unearned revenue are the balance sheet account. So the cash is an asset, but an unearned revenue is a liability. So the transaction does not immediately affect the income statement. Dear friend, even if you have received this amount, because it is not related to this period, it is not immediately affected the income statement. If training fees is monthly provided, yes, if training fees is monthly provided, as each periodic or monthly is delivered, the liability or an unearned revenue is reduced by Rwandan fra 2,000, while revenue is also increased by the same amount, by the 2,000. So you have, as to this example, you have at the first date you have received 24,000 for the 12 month. If you cross 1 month, so the 2,000 are the money which are related to that month. So that money is reduced to the liability and increase the revenue of that month. So what we are going to do is to debit the unearned revenue 22,000 and credit a specific revenue to 2,000. Dear friend, dear brothers, dear followers of this Patera TV, let me also talk about the prepaid expenses. Prepaid expenses are expenses paid for in advance. Anytime you pay for something before using it. So prepaid expense is, for example, when as the tenant you were paid rent to the landlord before using the house of the landlord. So those rates are one of example of the prepaid expenses. Anytime you pay for something before using it, so what you have paid is prepaid expense. So you must recognize it, prepaid expense accounting. Anytime you pay something, before using it, you must recognize it to have prepaid expenses accounting. Prepaid expenses in the balance sheet are listed as current asset. It is understandable. You take your money and you paid for the services you are not using. So that money you have paid for the services or for the product, but that product or that service you have not using it, so that money is your asset, is your current asset. To create your first journal entry for the prepaid expense, what is it? You debit your prepaid expense account. Why? This account is an asset account. As stated above, prepaid expense is your asset. So the first journal entry for prepaid expenses, you start by debiting your prepaid expense account. And assets are increased by debit. And for every credit, as you see, double entry concept. As for every debit, there must also be a credit. So when you debit a prepaid expense account, you are going to credit the corresponding account used to make the payment. So if you have paid services or product using cash, you are going to credit cash. Or if you have using check, you are going to credit check. Crediting the account to decrease your cash or checking account. For example, Patera TV pay in advance rate quarterly. Patera TV pay to landlord 112,000 3 months of rent, but in advance. So the amount is recorded as an increase in prepaid expense and decrease in asset provided. In this time, we are going to debit the prepaid expense account 12,000 and credit asset maybe cash you have used it to pay that rate or check. You credit that check or that cash 12,000. If rate is provided monthly, it means that every month the rate for every month is equal to 4,000. So there is a reduction in prepaid expense and increase in specific expense account at the end of each month. So for example, if in 3 months you have ended the first month, we are going to decrease the prepaid expense and increase our specific expenses. If our specific expenses are rate expenses, so we are going to increase rate expenses and decrease the prepaid rate expenses. So we are going to debit specific expense account if we have ended one month with 4,000 francs and decrease which we credit prepaid expense account with 500. So dear friend, dear followers of this particular TV, this is how to record these two items. So according to the preparation of the statement of profit and loss account as asked for this question is under. So we are going to start by the preparation of the statement of profit and loss account as at 31st July 2015. So as you have seen above, the sales revenue is equal to 50 million. So less cost of goods sold, which is 20 million. So the gross profit is 30 million. Other income, we have seen the gain on disposal. So the gain on disposal in our question, dear friend, is equal to gain disposal is equal to 500,000. So the total income for our question is equal to 30,500,000. So expenses, you have insurance expenses, which is equal to 1 million. We have bad debt expenses, which is equal to 2 millions, and the surplus expense, which is equal to 1,500,000. Utility expenses to 900,000. Advertising expenses is equal to 2,800,000. Total expenses for our question is equal to 8,200,000. So the profit before tax is equal to 22,300,000. So the profit after tax, we are going to take the profit before tax applied to 30%, and we see that the profit after tax is equal to 15,610,000. So this is our statement of a profit and the loss account. Dear friend, dear followers of this particular TV, let me go quickly on this statement of financial position. So the statement of financial position of our question, you have asset, fixed asset, you have buildings, which is equal to 80 billion. Okay, this accumulated depreciation, and we add the 2 rand, which is equal to 15 million. The total fixed asset is equal to 88,500,000. Current asset, you have finished the goods inventory, which is equal to 17 million. Add up to work in process inventory, which is equal to 9,310,000. Raw material inventory, which is equal to 15 million. Cash, which is equal to 27,190,000. The total So dear friend, the total current asset is equal to 76,500,000, and the total asset is equal to 165 million. So the liabilities: equity, we have common stock, which is equal to 50 million, retained earnings, as you have seen in the statement of profit and loss account, which is equal to 15,610,000. Treasury bond 30 million, and the total equity is equal to 95,610,000. So non-current, the non-current liabilities, you have 3 years note payable, which is equal to 10 million, long-term bank borrowings, which is equal to 15 million, 5 years bond payable, which is equal to 18 million. Total current liabilities is equal to 43 million. And the current liabilities, we have 5 months note payable, which is equal to 4 million, suppliers 2 million, tax payables, which is equal to 6,690,000, account payable 8 million, and earned revenue, which is equal to 5,700,000. So the total current liability is equal to 26. So the total current liabilities is equal to 26,390,000. The total equity and liability is also equal to the total asset, which is equal to 165 million. Dear friend, dear followers of this Patera TV, this is the end of our suggested answer. Our suggested answer of the discussion is this we provided on this video. Dear friend, dear followers of this Patera TV, don't hesitate to give your query in comment below of this video, but I am also asking you to subscribe to this Patera TV if you have not subscribed. Share this video, like this video, in order to continue to get more video about this suggested answers. So thank you for watching this Patera TV. Stay in peace. You can contact me, you can contact us on 7028777530. You can WhatsApp me, contact me on that addresses. Thank you for watching. God bless you. Stay in peace.